When you raise interest rates, you actually blow out the federal deficit more than you slow down total bank lending. Stocks are near record highs, but consumer sentiment is literally at record lows. Like since it's been measured nationwide, going back to like the 50s, the winners of the system, of the kind of the fiat system over the past, call it 40 years, 50 years, is those who short the currency in a safe enough way that they don't blow up during recessions.
Okay, so when you put all three of those together, consumer sentiment at record lows, corporations quietly shorting the dollar for 50 years, and the Fed's own tool now working against itself, you start to realize this isn't a rough patch. The entire system has structurally shifted, and most people are still playing by the old rules. That's what this conversation is about. Subscribe and stay to the end, because Lyn goes even deeper, and it will completely change how you see your money.
I've been describing this as a macro heavy decade. And so the advice to either ignore macro or include macro can vary much depending on the times. I think to Buffett and Munger's point, I think during that 4 decades of falling interest rates, from the early 80s all the way up basically to, to the global financial crisis and thereafter, really to 2020 in some ways, you could mostly, if you're in the US at least, you could mostly ignore macro, focus on value or growth or reasonable price investing, or even passive, and just do exceptionally well. And I think really only in this kind of age of fiscal dominance, massive liquidity injections, record tightening of central banks after those injections, and then geopolitical issues and things like that, macro has kind of inserted itself whether we like it or not. I think it's useful to have it as an overlay more than we needed it, maybe in the 90s, for example. So yeah, I think different advice for different ages of time. So if you hold any securities, whether it's government bonds, equities, corporate bonds, or bank deposits or central bank deposits, all those assets are basically types of securities or security adjacent, and they can just be frozen with a stroke of a pen by the country that oversees their issuance. Some countries will hold gold, but they'll have it in another jurisdiction. They hold gold IOUs. And again, they can just be like, well, they're frozen now. Thanks for playing. Whereas if you hold gold tonnage in your own jurisdiction, nothing short of like war can come and get your gold, right? So it's a form of kind of defense. So is diversifying your reserves so that at least your IOUs are spread out between more than one jurisdiction. Some of those jurisdictions might not like each other, so they might not agree to collectively freeze your reserves. So I do think that that's a really big component. And then two, instead of real rates, I think it's best to think of them in terms of dilution rates, which is a higher hurdle. So when we look at real rates, people will look at what interest rates are, say, treasuries paying versus forward kind of break even inflation expectations as measured by like the TIPS market, for example. That's a common way to do it. I think a better method is to look at money supply growth for the jurisdiction in question, let's say the US. So in the US, money supply growth is historically above inflation levels because we have technological productivity increases that offset some of that money supply growth. So let's say every year, money supply grows by an average 7% a year. We get 3% more efficient at making stuff. And so over the course of a long time, we have something like 4% inflation. Obviously, it's bumpy. Sometimes we have double digit inflation. Sometimes we have sub 2% inflation. But let's say it averages to 4. Real interest rate market would look at that 4%, whereas the actual dilution rate is at 7%. If the money supply is growing by 7% and you're holding treasuries that are paying you 3 or 4, you're getting diluted by 3 or 4% a year in terms of like your share of the overall dollar network. Whereas when you look at gold on average, according to most estimates, grows in supply by 1 to 2% per year. So around 1.5% on average. And so that's your dilution rate, 1.5%. Whereas if you're holding T-bills at 3% and the money supply is growing at 4%, 7%, then you're getting diluted at 4%. Stocks are near record highs, but consumer sentiment is literally at record lows. Like since it's been measured nationwide, going back to like the 50s. So in like 70 years of data, this is like going through the late 70s malaise, going through the global financial crisis, going through COVID. Those were all low points. This is somehow even lower because people are working full time and yet having trouble making ends meet and not really being confident in the direction of things. And so it impacts negatively almost everyone. But yeah, I think the world can absorb 100 to 150 nominal oil prices, even though it's unpleasant when you make that transition. A big part of whether a person or a company is doing well starts with the question, are you on the right side of fiscal deficits or not, right? So if you're in the business that is either receiving deficits or caters to those that are on average receiving deficits, you're probably doing pretty well right now. Whereas if you're in a business that is not really on the receiving side of deficits, and if anything is a little bit harmed by tight monetary policy, if you're a realtor right now, right? So no one wants to sell their homes because they locked in their 3.5% mortgage. No one really wants to buy a home because they don't want to pay current mortgage rates and they can't really afford the high prices mixed with high interest rates. So turnover is very low, even though there's not been a collapse in real estate prices, but this turnover just has collapsed. So if you're in the business where you depend on volumes of real estate turnover, you're out of luck. It becomes kind of very binary in that sense. Of course, the other variable unrelated is AI capex spending. It's so big these days. So if you're on the right side of kind of fiscal deficit or AI capex, you're on the good side of the economy. And if you're on the losing side of tight monetary, or at least not on the receiving side of fiscal deficits, you're impaired. And that, of course, leads to all sorts of political polarization. Instead of just kind of, when there's kind of that strong of a thumb on the scale, there's bigger debates on where that thumb should go versus if that thumb was smaller. And then, like I said before, when you have over 100% debt to GDP, and if, like in the US, annual fiscal deficits are bigger than all bank lending combined on net. So that the sum of new bank loans year over year is smaller than the annual fiscal deficit. And even net new bank loans plus corporate bond issuance, that's roughly the same size as the entire federal deficit. And so when you get that much kind of public debt to GDP and those large deficits, when the central bank says, okay, we want to slow stuff down, we want to slow credit formation, slow money supply growth, so we're going to raise interest rates. The problem is you do slow down that private sector stuff to some extent, but then you blow up the fiscal deficit by an even bigger number. So you actually, in some ways, accelerate total credit growth by raising rates. And that's a state of fiscal dominance that Japan's been in for a while, and the US is kind of more recently entered. Like I mentioned before, we've had decades of these imbalances. And while I do think that the US at one time benefited from having the reserve status, especially during the Cold War, I think it was a massive tailwind. And then even a little bit afterward, I think now the deindustrialization we've had from being the reserve currency issuer is now a bigger factor than how well New York and the government have done by being dollar and dollar security exporters. To the point where, like I said before, even the military is like, why can't we build enough stuff? And it's like, well, that's what happens when you deindustrialize your industrial base, when you produce 1/10 of the steel that China can do, for example. Their economy's kind of balanced the entire opposite way. It's interesting because all those alliances are really important in the beginning and the middle period of kind of growing and maintaining that network. The weird thing is that at a certain point, it kind of takes a life of its own where you have this network effect. And people often refer to the petrodollar. And it's like, okay, if a handful of countries decide to price something else, their energy outside of the dollar, that they could unravel it quickly. But it's actually more resilient than people think because the biggest factor is actually the dollar denominated debts, the cross-border dollar denominated debts. And depending on what measure you look at, there's something like 18 trillion in cross-border dollar loans and securities that are mostly not owed to the US. They're owed to all these different entities around the world. Some entity in Brazil will owe dollars to an entity in China, for example, or some entity in Africa will owe dollars to an entity in Europe. There's a game theory where it's hard to be the first to default. I mean, it's not like it's not like the whole world can just get together and just default on all that and say we're doing a new system now. More like you need a very extreme situation for that to become a real possibility. In general, dollar creditors want their dollars paid back to them, and the dollar debtors, when their bills due, if they're the first to default, they're the one that gets the horrible credit rating and no one wants to lend to them again in the future at any sort of reasonable rate. And so all of that cross-border dollar debt represents inflexible demand for dollars. And that's and that can change over time. I mean, you can, a creditor nation like China can say, okay, here's dollars, pay back your dollar loans, and now your debt's denominated in our currency, right? And we'll give you a swap line, right? So there are piecemeal ways to slowly chip away at that network effect, but they're very kind of long processes. Kind of like how reshoring an industrial base is a really long process. You can't just snap your fingers and say, okay, we're going to produce as much steel, electricity, and manufactured goods as China, or we're going to move that to other countries. It's just, it's way harder and longer than it sounds. And the same thing's true for the dollar system. So yeah, I already think we're in a world where the US, we're in the intermediate term, we can, like right now, we're acting like a wrecking ball, but we don't really see any sort of uptick in de-dollarization because, again, those network effects are very strong. Now, if you do this for many, many years, you increasingly incentivize other workarounds. Like when we sanction Russia, we force them to do business with China in their own currencies, for example. The whole BRICS and Shanghai Cooperation Organization, kind of the China centered rest of the world, the non West world, is a growing kind of consortium of bilateral or in some cases bigger moves to de-dollarize payments. And I think the uptick in gold usage is part of that. That's, it's not that Chinese currency replaces the dollar. It's that one, neutral reserve assets like gold gradually replace the dollar as a reserve. And two, that just more payment options than just the dollar exist at scale, which is that if a country's sanctioned, they can still do business in other currencies. And I think those are fully underway. So the dollar kind of gradually goes from becoming like the only game in town to like the biggest, but still a plurality, one of many big options. I occasionally use leverage, but for the most part, I look for other entities that are using it effectively. One of the things I've said before is that the best like product that Coca-Cola or Procter & Gamble ever sold was their bonds. Or another way of looking at it is Coca-Cola's been around for over a century. They're almost always profitable. They've been profitable like longer than we've been alive. Why do they have any debt? Why do they have $40 billion in debt? And the reason is because they can. It's an arbitrage. When, especially pre-COVID, before higher rates, they could borrow at like 3% for like 30 years, 20 years. That's basically shorting the currency. And whenever you can borrow at a rate that is much lower than money supply growth, so if dollars are growing in supply by 7% a year, and you can borrow at 3% and lock in that rate for a super long time, you can use that money to buy scarcer things, including your own stock, an acquisition, more equipment, real estate. You can buy all these things. And so really the winners of the system, of the kind of the fiat system over the past, call it 40 years, 50 years, is those who short the currency in a safe enough way that they don't blow up during recessions. The same general principle still applies. Like in my personal life, for example, we got a house. We didn't need a mortgage, but we're like, if they're gonna let us borrow at 3.5% for 30 years, do I think my investments, like, should I sell equities? Should I sell things that I think are going to do better than 3.5% to just buy this house free and clear? No. And the same thing, we have an Egyptian property. Money supply there is growing by 20% a year or so, and we could borrow the equivalent of like 4%. It's like, all right, we'll make that. It's like a 7-year deal. And it's like, I'll short the Egyptian pound for 4% a year for 7 years, if you'll let me, instead of having to sell equities to buy that property. So that's kind of the only place I use. I use kind of like real estate tied, low interest rate, non-callable leverage from time to time. But for the most part, I let my equities do it for me.
So here's the big takeaway. We are living through a historic shift. The rules that worked for 40 years and ignore macro, just pick good companies, trust the Fed, those rules are bending. Fiscal dominance means the government's debt is now bigger than the entire banking system's lending, and that changes everything. If this conversation got you thinking about where money is actually heading, you need to understand Bitcoin. And I mean actually understand it, not just the hype. The only Bitcoin investing book you'll ever need breaks it down from absolute zero. No finance background required. It's the clearest beginner's guide out there, and it connects directly to everything Lyn was talking about. Broken money, fiat currency, the shifting financial system. Link is in the description. Go grab it.